When even the biggest online retailer in the world starts the year by cutting tens of thousands of jobs due to a rapidly deteriorating economic environment, then you know that the outlook for 2023 is a whole lot uglier than we could have imagined. In fact, Amazon's CEO just announced that incoming layoffs will be nearly 50% higher than previously estimated as the company grapples with slower growth, declining sales, plummeting profits, and a grim stock market performance. Fears of a severe downturn are stirring the e-commerce giant to aggressively cut costs in preparation for even tougher circumstances for businesses in the months ahead. Consumers are seeing their purchasing power evaporate while interest rates rise and unemployment rates start to climb once again. What we're about to face next may come as a shock for many Americans, and that's what we're going to expose today. Amazon's new CEO Andy Jassy, who took over the role in July 2021, is in an aggressive cost-cutting mode as the company confronts the compounding effects of 4 quarters of disappointing results, slumping sales across the board, and a gloomy economic landscape for 2023. The recent wave of frugality is uncommon for the online retailer, which is famous for its generous investments in different areas of the market, new sales programs, product development, and hefty expansion over the past decade. In fact, since 2018, Amazon's employee base has swelled from under 650,000 to 1.6 million last year. But in recent months, things have taken a massive turn for the worse for the e-commerce retailer, consequently resulting in the permanent shutdown of many of its programs, including its telehealth service, as well as the discontinuance of its video calling projector for kids, the closure of all but one of its U.S. call centers, also discarding its roofing delivery robot project, shuttering almost all of its brick and mortar locations around the country, and canceling plans for opening new warehouse locations. On top of that, Amazon is drastically reducing the size of its secretive Skunk Works Lab Grand Challenge, according to Insider. Last month's annual hardware event, which normally showcases a roster of gadgets and robots that may or may not still be around in a year or two, was noticeably constrained compared to prior launch events, the outlet reported. On the recruiting front, the company is freezing hiring in many sectors, including its retail business, and Andy Jassy just announced that mass layoffs will continue throughout 2023. On Wednesday, the executive announced that Amazon is cutting over 18,000 jobs, almost 50% higher than its December projection that around 10,000 positions would be slashed. The looming job cuts represent the single largest number of layoffs announced by an online retailer since the industry began aggressively downsizing last year. Several teams will be affected, Jassy said, including the Human Resources Department and Amazon stores employees. The CEO added the staff reductions were set off by the uncertain economy, highlighting that the measures will help Amazon to reestablish its financial health after a year of major losses. But he called the cuts a difficult decision, noting he is deeply aware that these role eliminations are difficult for people, and we don't take these decisions lightly or underestimate how much they might affect the lives of those who are impacted. The company will start informing affected staff from January 18th. He said, the move comes after Amazon reduced its headcount by 99,000 people in 2022. The current trend of belt-tightening has raised questions amongst investors about whether the financial problems faced by the online retailer in the past few quarters will persist as the recession accelerates. Last year, Amazon was one of the main big tech companies to experience an alarming growth and slowdown just as inflation reached a 40-year high and crimped sales. In the fourth quarter, Amazon disappointed Wall Street with a holiday season forecast that woefully missed analysts' expectations. The company's stock fell about 20% after releasing its earnings outlook, and its stock closed the year 50% lower than at the beginning of 2022. The industry titan suffered steep losses in year-over-year income as shifting shopping habits and inflationary pressures threw the retailer for a loop. In its most recent earnings report today, Amazon has revealed that operating income decreased to $2.5 billion compared to $4.9 billion in the same quarter last year, while net income dipped from $3.2 billion to $2.8 billion. Operating income refers to earnings after expenses minus the cost of debt, taxes, and certain one-off items, while net income represents the profit remaining after all costs are subtracted from revenue generated from sales. Amazon expects that its fourth quarter operating income will fall from $7.4 billion in 2020 to $4.2 billion in 2022. You heard that right. The largest e-commerce retailer on the planet, Amazon, may record $0 of operating income for the last quarter of 2022. The warning sparked another sell-off on Wednesday, shares shedding 4.3%, which dragged its market capitalization to about $879 billion from a record market value of $1.88 trillion. This has been the first time the company took its market cap below $1 trillion since April 2020. The latest decline has effectively erased all of the stock's gains since during the pandemic surge. Some say Amazon is on pace for its worst year since 2008 when it dropped 55%. The only other year that was worse was during the dot-com crash of 2000 when the company lost 80% of its value. From a micro perspective, the collapse in Amazon's market value is largely due to its poor business performance over the 4 quarters of 2022. Data shared by the company shows that Amazon's e-commerce sector delivered sluggish earnings results, with profits declining by almost 10% to $2.9 billion, with most key financial indicators falling short of market expectations. At the same time, from a macro perspective, the difficulties the US-based tech giant has been coping with reflect some serious structural problems faced by the entire US economy. At the end of the day, what's really fueling Amazon's disappointing sales performance is shrinking online consumption by US consumers. The combination of a global recession and a bleak macroeconomic environment with rampant inflation and tightening monetary policy is crushing Americans' purchasing power, and their finances may suffer an even harder blow in the coming months. Amazon announced that soaring energy prices are impacting its business in a major way, with the company spending on shipping climbing to $19.9 billion in the past couple of quarters. As a result, the e-commerce platform will add a 5% fuel and inflation fee on online merchants that use its shipping services, according to documents reviewed by Bloomberg, putting pressure on sellers to raise prices and ultimately impacting the consumer. The surcharge is the latest indication that rising operation costs are still denting the online retailer's bottom line. It'll apply to US sellers that use the Fulfillment by Amazon service that stows, packs, and ships products, it said. Last year, Amazon merchants already took cost-related fee increases that averaged 5.2%. Consumers will lose, warns Dan Brownshire, who runs Channel Key, a Las Vegas e-commerce consulting business. Amazon already raised fees in 2022, so sellers will have to raise prices again. Like many, we've experienced significant cost increases and absorbed them wherever possible to reduce the impact on our selling partners, Amazon said in an email. In 2022, rising fuel prices and inflation have presented further challenges. It is still unclear how long these inflationary costs will persist, it said. We absolutely will need to raise prices, stressed Molson Hart, whose Via Heart Toy Company sells educational toys and other products on Amazon. Some sellers cannot because customers are not accepting the new higher prices. Hart exposed that these already had to take lower profit margins on some larger products that are more expensive to ship because consumers wouldn't pay the higher prices. In general, people reduce purchases of non-essential items when money gets tight, He explains, "This means that online shoppers won't be immune to facing steep price hikes and seeing fewer promotions and discounts in 2023. The added costs are coming after the e-commerce giant raised its annual price membership rate from $119 to $139. The upcoming spikes in prices at the platform may ultimately make things even more complicated for the online retailer. It's important to note that one of the most critical factors undercutting Amazon's performance in the last few quarters is that millions of American consumers who have made purchases online during the pandemic have resumed the pre-pandemic habit of buying at physical stores where they can use coupons, they can stretch their dollars as far as possible amid the massive jump in basic expenses. As a result, e-commerce sales are expected to continue to lose steam, particularly now that prices are looking less attractive. On top of all that, beyond the shift in consumer habits and declining consumption, the problems facing Amazon and the U.S. e-commerce sector is that it doesn't have the sufficient supported needs for development from the real economy and logistics system. Most of the growth experienced by the sector was tied to 2021 stock market boom that led shares to balloon to record highs in the expectation that the economy would see a V-shaped recovery that never really came to fruition. The tech bubble formed since that period is catastrophically bursting right now, with many big names facing billionaire losses. This is a stark reminder that what happens in the real economy is what really matters, and Wall Street has clearly overestimated the growth that Main Street could generate after falling into an inflationary crisis and losing hundreds of thousands of businesses since the burst of the health crisis. Meanwhile, the systemic problems of the U.S. economy, which has deviated too far away from the real economy, have now precipitated the decline of its hegemony, and many big companies are also having to implement sobering cost-producing measures to brace for the challenges that are right at our door. In recent weeks, a number of CEOs have been admitting that they failed to accurately assess consumer demand, and now they're watching their rosy projections turn darker and darker. Major market players like Facebook parent Meta recently announced 11,000 job cuts, the largest in the company's history, while Salesforce just said it would cut 8,000 of its staff. Vimeo CEO Anjali Sood told employees on January 4th that the company would lay off 11% of its staff, the video platform's second major round of layoffs in less than a year. "This was a very hard decision that impacts each of us deeply," Sood wrote in an email to staff. Even Goldman Sachs revealed plans to lay off up to 8% of its staff in the first half of January, a person familiar with the matter told Insider in December. We continue to see headwinds on our expense lines, particularly in the near term," Goldman Sachs CEO David Solomon said at a conference last month. Morgan Stanley and Citibank are also planning to cut roles this year, according to data cited by the Wall Street Journal from layoffs.fyi, a site that's been tracking layoffs since the start of the pandemic. Tech companies alone slashed more than 150,000 in 2022, compared to 80,000 in 2020 and 15,000 in 2021. The latest job cuts report from employment firm Challenger Grain Christmas showed overall layoff announcements surged a whopping 649% from 2021 levels, and they're likely to climb even higher in the months ahead. 2023 is set to be a hungover year after the pandemic downturn and the past couple of years of inflation growth. Under or later, 6-digit layoffs will start being reported. Unfortunately, these job cuts mean that our population will suffer immensely for yet another year. We hope you have found this video informative, and if you want to keep tuned with the next ones, please don't forget to turn on the notification bell. Thank you very much for watching.